Welcome back to Investment Blueprint for Passive Investing. It's a series of 10 episodes under 10 minutes who teaches you how to build a portfolio with passive instruments through our channel. In our previous episodes, we discussed the growth story of India, the benefits of diversification, and the importance of investing in American market. Today, we'll be talking about a popular investment strategy known as factor investing and how it can spice up your portfolio with smart beta strategies. And to help us understand this concept, we have with us Pratik, a financial expert with years of experience in the field. Welcome, Pratik. Welcome to our show. We're on the 8th episode already. How does it feel?
Hi. Great to be here. It's been fun. And I hope we can do a lot more of these in the future as well. So yeah, thanks so much.
Definitely. And I'm really excited for you to be a part of this because I think you represent our type of investors of today's world who are like exposed to a lot of media today, in terms of social media, influencers, and then we're also working at the depth of creating new products altogether. Like the recent product that you put out, the micro cap fund, also caters to new avenues that we're looking at. And I'm sure your insights on the show would really help our viewers to move forward. So without any further ado, I would like to ask you on this episode, what is factor investing and what are these factors that everybody keep talking about, when it comes to investing in passive instruments?
Yeah, so if you look at ETFs or index funds, passive funds, these are all rule-based products.
Yeah.
And I think like an index fund, for example, the rule is that the largest company will get the largest share of weight.
Yes.
So very simple. It's size-based. Size is the rule. And I think that's how sort of most of these index funds, ETFs, are based. Now, what happens in factor funds is that they're also passive funds, but the rule is different.
Okay.
The rules can be changed, and I think factor funds are basically passive funds that where stock picking or which stocks come in or which stocks go out follow a certain type of rule.
Okay.
I think if you I think
Would you call it very closest to an active fund in a way?
Yeah, I would say that the whole idea about factor investing is that it has the costs of a passive fund.
Okay.
But if you're able to invest in factor funds for a long time,
Yes.
they've also shown that they've outperformed your traditional Nifty and Sensex.
Yes.
So I think a lot of investors who look at factor funds, want the best of both worlds.
Okay.
They want the outperformance that comes with an active fund, but they also want the cost of a passive fund. That's where sort of factor funds come in.
Okay.
But even within factor funds, I think it's important to understand that factors are essentially, certain characteristics, which sort of explain the returns of certain type of strategies. There are also different styles. You're basically betting on a certain style when it comes to stock picking as opposed to size. Even size actually is a factor.
Okay.
So size, when you look at index funds, ETFs, you're looking at size, and that itself is a factor.
Yeah, Nifty 50 for that.
Nifty 50, for example, is actually a factor fund, but the factor is size.
Yes.
Whereas you have other factors like value, like momentum, like low volatility, I think quality.
Yes.
These are the 3 or 4 factors that are extremely popular.
Okay.
And they sort of have certain rules put in place that allow certain stocks coming into the indexes.
Okay. So when you say value-based factor, right, or momentum-based factor, so the momentum factor for all AMCs remain the same when anybody is coming up with a passive fund for momentum for that matter?
Yeah. So momentum is one of the factors. Basically, what momentum says is that you would basically have a fund which will have stocks that are in momentum.
Okay.
Stocks that have appreciated the most in the last 6 to 12 months time.
Okay.
So you're betting on a strategy saying that, boss, the stocks that have done well in the last 6 to 12 months will continue to do well in the next sort of 1 year, 2 years, 3 years.
Okay.
And this keeps changing.
Okay.
So the idea behind betting on momentum is betting on the fact that stocks which have recently done well will continue to do well in the near future.
Okay. And this is purely on the basis of stock price.
Yeah. So basically, unlike active management where there is certain types of biases, here it's completely I would say systematic. It's completely
statistics driven.
Yeah, statistics driven. It's also very transparent.
Okay.
So everyone who knows that okay, this stock has come in this factor. They know exactly why it's come.
Okay.
So the rules are very transparent. So
Makes
for example,
sense.
if you're investing in a factor called low volatility, which chooses stocks that are very low volatility, very stable stocks.
Yes.
You know that these stocks have the lowest standard deviation, or, in the market.
Okay.
That's why they're part of this index.
Okay.
So factors come with a lot of transparency, and I think a lot of investors can use single or a combination of factors in their portfolio.
Okay. So what about something as intangible as value? You talk about value-driven factor funds,
Yeah.
So what does value, because the definition of value may differ for different people, right?
Yeah.
So how do we come to understanding something like value?
Yeah, exactly. So, value is something which is, very subjective.
Yes.
And in a factor fund, there is no subjectivity.
Okay.
The methodology is completely objective,
Okay.
and this is a methodology which is recognized globally.
Okay.
So the value factor in India will be very similar in terms of methodology to the value factor in the US or in Europe. So in our case, so in the India's case, so I'll explain the 4 factors, and for our viewers. And so I mean, there are many factors, but these 4 are the most important factors.
Yeah.
The first one is momentum. We spoke about momentum is basically betting on stocks that have had initial momentum. So the stocks which have the highest sort of appreciation in the last 6 to 12 months are part of this index. So you're betting on those. Then there is low vol. Low volatility are basically betting on stocks that are extremely stable, have very low standard deviation, do well across market cycles. The third one is quality. You're basically betting on companies that are high in quality. And by quality, this is not subjective, this is objective. This is quality, basically stocks that have great returns on, say, great return ratios, so ROE, ROCE, stocks which have very low leverage, and stocks which have high profitability. So combination of these 3.
Low debt, high earning.
Low debt, high earning, and high profitability. A combination of these 3 will be used as a filter to figure out which are the quality stocks, and that will be in our portfolio. And fourth one is value. Value obviously is different, but in our case, in the factor level case, value is basically the stocks that are cheapest. And this is defined by price to earnings and price to book.
Makes sense.
So I think these are the 4 factors that are the most popular, and these are the rules that govern these 4 factors. And I think by betting on, and what we've seen historically in the US and also in India, that there have been, over the long run, a lot of these factors have outperformed the broader index. But it's also important to understand that this is not consistent. So certain factors work in certain times. So if you are looking at a factor index to buy or to invest in, you have to make sure that you are giving it time for it to start work. Just like an actively managed fund, there might be periods of outperformance and underperformance. That's exactly the same for a factor fund. So when you're buying a factor fund, you have to sort of give it the time for it to start to play out for the long run.
How much time are you thinking at? Because we're looking at mid cap and small cap, investments also for a long term of time, right?
So mid cap and small cap are more high volatile sort of sectors. So I think investors who are okay to take that risk should go with mid and small cap indices. But in factors, because you're primarily playing in large and mid cap, it's not as risky as mid and small cap. It's less risky, I would say.
Makes sense.
Because the stock profile is less risky. And also within that you have low vol, which is even less risky. So I would say that investors should look at least a minimum 5 to 7 years period when they're looking at equity funds, especially factor funds. Because and obviously if the factor underperforms the market, investors should not be disheartened, because that's supposed to happen. Different factors work in different market cycles.
Makes sense. And they go through different cycles.
Exactly. For example, a momentum fund would do very well in the bull market. A low vol fund will do very well in the bear market, because you're buying high quality and very sort of stable companies. Value will do well in a very recovery market, because you're buying stocks very cheap. So I think different market cycles have different factors working for it. Which is why I think a combination of factors or giving the factors time is very important for investors to create wealth.
So would it be safe to assume that something like momentum and quality and value, for that matter, may give better returns than low volatility and quality?
Not really. There's no, I mean, it really depends. There is no fixed rule like that, that certain factors do better than other factors. I think in the last 20 years, one factor, which is value, has been the least consistent. I think that has underperformed. In fact, last 2 years have been great for value. But I think value is one area where I think there is a huge debate between if it's a good factor or not.
Okay.
But the other three, I think, have shown, I think, excellent past performance and
Beating
consistent.
Nifty?
Beating Nifty, I would say all three would do it
Okay.
over the
Over
long
a
term.
period of more than 5 years.
I would say more than 5 years, I think it'll beat the Nifty. At least historically, it has beaten the Nifty comfortably.
Which one of the factor investing models would you prefer for yourself?
I think if you look at globally, the most popular factor in the world is low vol.
Okay.
So low vol is an excellent factor because you're basically buying very stable companies. You're basically buying companies which do well in bull markets and bear markets. When the economy is doing well, economy is doing badly.
Yes.
It has high exposure to consumer names, healthcare names.
Haan.
So you're looking at very stable balance sheet P&Ls. So I think low vol is a great investment for someone who's looking at equity investing, but is looking at buying very stable stocks.
Yeah. Do people also use it to park their money, like how they park it in FDs? Or
no, so
debt
this is
funds?
an equity product, so not really advisable to park your money. This is an equity product, so it will be volatile. It will come with the same volatility as what you would have in a Nifty or a Sensex. So may not be advisable to park your money.
Which is the name low volatility.
Yeah, I mean that's a strategy. So the strategy that you are betting on is low vol. So I think parking your money like a liquid fund or a short-term fund is much better if you want to park your money. But I would say this is mostly for investors looking at a 5-year plus horizon.
Okay. One question that I want to personally ask is, with every type of investment, there are always downsides or some risk associated with it. Considering there are 4 here, is there like a common thing that you need to avoid while investing in all of these? What are the risks associated that you would like to highlight?
Yeah, so I think factor investing can be good as a tool for diversification and also getting that added excess return, as I said. The risks are that, like any other actively managed strategy, there will be periods of underperformance and outperformance.
Yeah.
So I would say that investors should expect that when they're investing in a factor fund. That's one big risk of underperformance. The second risk is the fact that unlike say index funds or even actively managed funds, past performance is important. I think in factor funds, past performance may not be as important because you are because factor works in different cycles. Yeah. So you might be investing in the end of the cycle. Yeah. So I think end of a bull run, and you might put the money in a momentum fund. Yeah. So I think for factors, you should look at what strategy you want to bet on. Okay. What do you think will do well over the next 3 to 5 years time? And that's what you should invest in. So I think past performance is less important in factor funds. Okay. And thirdly, I think factor funds have a lot of churn. Yes. So the unlike a Nifty fund, which is I think less than 15% churn, factor funds tend to have 70, 80, even 100% churn. Okay. So investors investing in a factor fund should expect the number of stocks going in and out to be much higher. Okay. So the transaction cost will be much higher. Even the tracking error of factor funds will be slightly higher than what you would expect in a Nifty fund. Okay. So I think these are some of the things that investors should keep in mind when they invest in a factor fund.
How much money, imagine I have 100 rupees to spend, right? And then I put most on my foundational investments, right? Like we spoke. How much money goes out of 100 rupees to something like this? Considering there's so many more, I'm pretty certain that there will be 10 more other types of factors which are not that popular. But as a unit altogether, factor investing, irrespective of how I use them internally.
Yeah, so factor fund should be part of your satellite allocation, I would say. There's core and satellite. Yeah. I would say the core should be a simple Nifty fund, 500, or a mid-cap 150. Yeah. Whereas a satellite can be a factor fund. You can put a momentum or a low vol. I think these two are very popular. In terms of allocation, honestly, it really depends on person to person. But, I think if you're able to take more than 10% bets, I think that's good for this sort of investment.
That's for a conservative investor?
Yeah, I think for a conservative investor, you should ideally look at conservative aggressive by equity allocation, not by which funds you buy. Okay. So conservative investors should have a less part of that proportion of their portfolio in equity. Okay. But within equity, I think they can have whatever proportion they want in factor funds. Yes. But ideally, you should look at 60% core and 40% satellite. Okay. So maybe part of that 40% of your satellite portfolio, maybe half of that can go in a factor fund.
Okay, makes sense. Are there any products that Motilal Oswal offers in factor investing?
Yes, so we have all 4 factors. So, low vol, momentum, value and quality. Okay. And we have index funds and ETFs for all. So if investors prefer ETFs, then they can go for an ETF. Okay. If they prefer index funds, they can go for index funds. Yes. They can also build portfolios. If you're
Yes.
looking at a combination of factors, you can do that with our funds
Yeah.
as well. So I think all four are there, and investors can choose what they want.
Now that we've taught them how to have a look at the fund document, we can perhaps ask them to go have a look and look at all the propositions that Motilal has on the
Absolutely,
website.
absolutely. I think it makes sense
And-
for investors to look at the funds and maybe search them a little bit, understand what they are, and how they can be beneficial
Yes.
in their portfolios.
Definitely. And with that, I think we've had another good conversation on how factors can influence your portfolio. And Pratik, as we know that we give out a task by the end of the episode, what do you think would be a task for an episode like this?
Yeah, absolutely. So the task for this episode is to learn more on various factors that exist and help us know which one suits the best for your individual needs, and select one or a combination of factors that they would invest in and why. And please share with us that answer in the comments below.
Yes. And not to forget, this is a 10-episode journey. So we're on our 9th episode in the next episode. So please be sure that you watch the other 7 before completing the series. So thank you very much for your time. Please like and subscribe and share this video with your friends. Looking forward to seeing you in the episode 9. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.